Private placements have become a popular way for companies to raise money without the complicated processes of public offerings. Instead of selling shares or debt to the public, companies sell securities directly to a small, select group of investors like institutional investors, private equity firms, or wealthy individuals. This method is appealing because it offers flexibility in deal terms, keeps information confidential, and is faster to complete. It's especially useful for companies looking to expand, buy other businesses, or restructure. The benefits include access to capital without the heavy regulatory requirements of going public, the ability to move quickly to seize opportunities, customizable deal terms to fit both parties' needs, and the chance to maintain more control by having fewer shareholders involved. The image here represents the security and controlled flow of investments that private placements provide, symbolizing how funds are directed efficiently and safely through a secure channel to support business growth. For companies not ready to go public or looking to avoid the uncertainties of the stock market, private placements provide a useful alternative. The process begins by determining how much capital is needed and why, such as for expansion or paying off debt. Next, the company decides what type of security to offer, whether equity, debt, or convertible instruments. Investors are then carefully chosen, often institutional investors or accredited individuals who meet regulatory rules. The terms, including pricing and exit options, are negotiated, followed by ensuring compliance with relevant securities laws like Regulation D in the U.S. Once all is agreed upon, the deal is closed with final documents signed and funds transferred. Real examples include Tesla raising $2 billion through convertible notes for its Gigafactory, and Airbnb securing $1 billion in private placement financing before its IPO. Many mid-sized companies also use this method to finance growth without public market exposure. The advantages are fewer regulatory hurdles, faster closing times, tailored agreements, and maintaining confidentiality. However, the investor pool is limited, and the cost of capital can be higher since investors expect greater returns for the added risk and lower liquidity. Securities issued through private placements tend to have reduced liquidity since they are not easily traded, which can limit the ability of investors to quickly convert these securities into cash. Additionally, investors involved in private placements may impose stringent covenants, meaning they could set restrictive conditions on a company's operations or its ability to secure future financing. Despite these challenges, private placements remain an important tool in corporate finance by providing companies with a flexible, efficient, and confidential way to raise capital. While they don't replace public offerings for large-scale funding, they offer a valuable alternative for businesses seeking strategic financing without the complexities and costs associated with public markets. By using private placements wisely, companies can obtain the growth capital they need while maintaining greater control and reducing regulatory burdens.